Welcome to another episode of Good Value by Antipodes.
As the S&P 500 breaks through its all-time high set 2 years ago, the market is taking the view that inflation has been tamed and that rates can fall while economic growth and employment can remain intact. And that even if the world's largest economy doesn't quite stick the perfect landing, the Fed has the wiggle room to prevent a hard landing. I'm Alison Savas, and in this episode I'm joined by Antipodes CIO Jacob Mitchell. We're going to discuss whether the worst-case scenario has been averted and what we're watching in markets in 2024. We'll also cover how the Antipodes portfolios are positioned, including shining a spotlight on one of our key holdings, Oracle. Jacob, Happy New Year. Welcome back to the podcast.
Thanks, Alison. It's great to be here.
So I covered the market's view in the intro, and while enthusiasm around the rate cutting cycle has tempered a little as the Fed's tone has recently erred a little more hawkish, I think it's fair to say that the market believes the Fed can achieve the soft landing. And look, the US economy has remained resilient. So can the Fed pull it off? Can the Fed pull off the perfect landing?
Look, they may be able to, but we still see residual risks around, the inflation war and lagged ramifications of tight monetary policy. Bonds and equities celebrated the recent 3% headline inflation print, but it is worth remembering that core inflation, which is what the Fed focuses on, came in at about 4%. The market assumes core inflation can fall to around 2.5% by the end of 2024. But we see it getting, potentially stuck around 3% at the mid-year mark, really due to the shelter component just being a little bit sticky. And also, look, the wild card is geopolitics. Given what we're seeing in the Middle East and the potential impact on energy prices and supply chains, and also just that longer-term structural trend towards onshoring. So look, just going back to the shelter component, which is basically rents and owner-occupier equivalent rent, it's worth paying attention to this as it accounts for over 40% of core inflation. Rents are still rising more than 6% year on year, and that upward pressure is coming from, we think factors related to the structural undersupply in US housing. And it's not just US housing. We see this in a lot of the Western housing markets. The lackluster recovery post the global financial crisis just led to a structural undersupply. And it's taken us a long time to get back to just sort of, let's call it the sustainable growth rate of housing. So, and we haven't gone above trend. So that means we still have to make up that underbuild, and that can persist, and that doesn't get easier with higher rates. That gets harder, and that's going to keep feeding into core CPI.
So what you're saying is that the trajectory for core inflation is down, but you have a more conservative view on where it may settle, and that it may settle at a rate that is higher than what the Fed is comfortable with. So the question is what that means for the pace of loosening, because the market is pricing in 140 basis points of rate cuts over 2024. And so that's around 6 rate cuts. And 6 rate cuts is what you'd expect to fight off a recession, as opposed to a resilient economy with above target inflation.
Yeah, look, that's right. I mean, everything around COVID has been somewhat exceptional. What we can say, I think we can say fairly safely, is that we're at the peak of the tightening cycle, and we will see some rate cuts over the coming year. In the back of the Fed's mind, though, they will be, I think, probably err on the side of caution, given the persistence of certain elements in the inflation deck. And so, look, we think there'll be some disappointment over the pace of loosening, and ultimately rates will stay, higher for longer. And look, on the economy, the US economy, it's been remarkably resilient. There's a lot of discussion around the delayed impact of tightening, the transmission to the real economy, and potentially that has lengthened. We know, we know that fixed rate mortgages, the US has the unique situation in globally in terms of being able to, the household can really lock in a low rate for a very long period of time, and that's supported the economy. So the labour market, we can see it loosening. Nominal wage growth is slowing. There's new leading indicators on the economy, like new orders are also weakening. And, we are going to have some slowdown in the economy. And US equities are priced on, this 20 times forward earnings, which, as we know, we're also in a market where there's a lot of multiple dispersion around that 20 times. And, the magnificent 7 or terrific 10 are on much higher, are on an average multiple that's a lot higher than that. And then the rest of the markets is lower. So, look, there's opportunities, but at the index level, we would argue, broadly speaking, there's not a lot of slowdown priced into US equities.
And as we look towards 2024, a topic that we've been talking about is the potential for deterioration in liquidity, given the funding requirements for this very large US fiscal deficit. And we've been talking about risks around the bond market sucking up capital as the Treasury looks to term out its debt. And that sounds like that could also be a headwind for US equities at the index level.
Look, I think so. I mean, the US deficit is now 6% of GDP. Now, it's not expanding anymore. So you could argue the positive impact of the expanding deficit is behind us, but we still have to fund a relatively high level of borrowing. And as it turned out in 2023, we almost had the Goldilocks scenario of having the benefits of the deficit coming in terms of activity, but no real cost in terms of the funding, given that most of the new debt was being issued at the very short end. So we almost saw in terms of the incremental funding of a deficit, it was almost a record year of maximum use of short-dated paper, bills, and the minimum use of longer-dated, bonds, bonds with a duration greater than 1 year. Now the stock of those, let's call it the bills, which have to get rolled, every other month, that is now at about 20% of total debt outstanding, and that's at the upper limit of the where the Treasury is sort of seems to be comfortable. So at some point, the Treasury has to start to term out the debt. They'll have to do more of the incremental borrowing. Will have to come in longer dated bonds. And look, the question is, who can buy that? And that's where it gets interesting, because the short-dated paper can be, money market funds where a lot of the excess liquidity has been parked. They can buy, these bills, but they can't buy, they certainly can't buy bonds. Like, once you go out beyond a year, their ability to participate drops away. And so, it's going to be more traditional buyers. Now, the question there, and they are insurance companies, they're banks. The question there is you're not getting a lot of compensation for taking duration risk. And that's what bond investors describe that as like term structure. The fact that the yield curve is negative means you're not getting that traditional benefit for taking longer duration risk, and that's, we think, is one of the key issues for the bond market, for the liquidity situation, and how that sort of, let's call it, rectifies itself. I think it's by the long end of the yield curve. The 10-year yield will probably have to stay relatively elevated versus a Fed, what the Fed may be able to do in terms of the policy rate, in terms of rate cuts. So they need to engineer not only a soft landing, but they also need to engineer some upward sloping yield curve, we think, in order to get the the fiscal deficit funded in an orderly manner. And as we know, in 2023, there were these episodic volatility, episodes of volatility in the bond market, which fed back into the risk asset prices more generally. Look, probably the other issue that we're focused on is just the amount of the size of the leverage, the growth in the leveraged loan market, and the high yield bond market. Although it's been leveraged loans and private credit where most of the growth has taken place. Leveraged loan market alone is about 1.25 trillion outstanding, and over half of that is held or used to essentially finance private equity backed companies. And most of that is floating rate, and not a lot is hedged. And that cost has risen. The cost of that debt is risen from roughly, let's call it at the lows, around 4% to now roughly 10%. And we calculate the statistic that we think is really telling is the median interest rate burden of these companies is around 40% of their EBITDA. But the poorer quality companies are as high as 90% of EBITDA. So that's quite unmanageable if rates remain higher for longer. And that debt will need to be refinanced in the next 3 to 5 years. So there is the risk that if the Fed can't cut fast enough, that the rate of defaults, or if the economy is softer than investors expect, that defaults start to bleed into the broader economy. We calculate that private equity employs roughly 7% of the total workforce. So it needs to be something to be monitored, quite closely.
So to draw a circle around all of this, what you're saying is that at the headline 20 times forward earnings, US equities are not factoring in the potential for a slowdown in activity from the lagged impact of tight monetary policy, or the potential for tightening liquidity. And we have the risks that you've just mentioned around PE-backed businesses. So the index is expensive, but opportunities still exist at the individual stock level. And that highlights the importance of paying, the right price or a fair price for the quality of a company and its growth profile, and not paying any price. And so I think that's a good segue into our portfolio. We still have a relatively defensive tilt. So can you take us through our current positioning?
Sure. Look, a couple of months ago, we did take the view that we could see a rally fueled by, expectations around central bank policy in the face of declining inflation. So we tactically increased our exposure to equities, particularly in the long-short strategy where our net invested position, we moved it to one of the highest since the inception of the strategy. Now, we're comfortable with that positioning for now, but it hasn't really changed our broader view that we expect to see greater volatility around both the economic and the policy cycle, and ultimately lower equity multiples. As you mentioned, the portfolio retains its, this sort of defensive tilt, but we have selectively added to some of the global cyclicals where we see the supply and demand dynamic as being attractive. Where for instance, you're seeing a bottoming of the cycle. The industrial production cycle has been very weak because it was mainly correlated to that really large slowdown in manufacturing as consumers pivoted away from goods and back to services coming out of COVID. So that has washed through. The global trade, goods trade has been very weak, and as we know, China hasn't really done a lot to offset the big slowdown in their property sector. So you have seen a destocking cycle in things as parts of the market like global chemicals, some of the industrial exposed hardware names, even oil and gas has been oil prices come back. And and that's given us opportunities to start to build some cyclicality into the portfolio. Now, the next stage will be whether or not we see, if the data remains resilient, and we think the inflation is coming sort of dovish in a more dovish manner, and the Fed can start to accelerate rate cuts, there is an opportunity to ramp up that cyclical exposure. And we'd be looking to also build into that, some of the exposure to the major longer term trends, whether it's the energy transition or supply chain onshoring, and also just the dynamic of, finding many of the multinationals, companies like Siemens or Saint-Gobain that have a decent exposure to the US, coming at a lower multiple than, let's call it, the equivalent company in the US. And we think that valuation arbitrage, can close. And it's a great way to play, the soft landing in the US.
At Antipodes, we talk a lot about the importance of finding tomorrow's winners rather than focusing on yesterday's success stories. And that includes looking for those mispriced beneficiaries of investment cycles that are going to dominate over the next decade and beyond. And you just called out energy transition and supply chain onshoring, but we also have cloud and AI. Oracle and SAP are two of the leading enterprise resource planning software providers, or ERP for short. Their core function is general ledger applications, as well as HR, financial planning, and supply chain management. And these two stocks, Oracle and SAP, have anchored our cloud and AI monetization exposures. So it was interesting that one of the more meaningful portfolio decisions taken during the fourth quarter of 2023 was to exit SAP while continuing to hold Oracle. What prompted that decision?
Yes, it's an interesting case study. When we bought SAP and Oracle a few years ago, the real key reason was we were looking at the adoption of front office software like customer relationship management, CRM, and it was happening. It was driving the growth of companies like Salesforce, and there was rapid adoption of CRM in the cloud. It got to a level of about 60%. Now, in the case of back office software like enterprise resource planning software, ERP, that adoption was lagging. It was still 70% on-premise, and only 30% had gone to a software as a service, a subscription-based, SaaS subscription-based offering. But the two companies that were leading that, Oracle and SAP, were perceived to be, let's call it mature, lower growth, when in fact they had a much bigger opportunity in front of them. And we thought coming out of COVID, the switch of, businesses would focus a lot more not on just driving sales from front office, but driving efficiency. And so ERP would get a lot more focus in the transition from on-premise to SaaS. And there's a lot of benefits for the customer in getting software into the cloud, because it allows them to cut the workforce that they have on-premise maintaining data centers, and at the same time, the companies that are supplying the software can take a bigger share of the pie. You end up with a subscription, a long duration subscription business, which will ultimately trade on a higher multiple. So that was the core opportunity, and we think it played out. It's been playing out quite nicely as the perception on SAP and Oracle has changed. Revenue growth has accelerated to, let's call it 5 to 10% over the past 3 years, compared to low mid-single digit growth prior to that. And SAP's stock price has responded. It's up 60% this year alone. It's re-rated to almost 30 times earnings. And we think, whilst we think it can keep growing at around 10%, we don't think that's an attractive multiple now for that type of growth. So we made the decision to sell, take profit based on really valuation discipline. And as a pragmatic value manager, we talk about paying the right price. relative to a company's business resilience and growth profile. But we also need to focus on the exit point. Sell discipline, is important.
And as we've exited SAP, we've maintained that position in Oracle. So how does the Oracle thesis and valuation stack up compared to SAP?
Yeah, look, we think we're number one for Oracle. We're now on around 20 times earnings for what we think is a higher growth profile. Let's call it low double-digit growth profile opportunity, and also more ways of winning. And it's that sort of, for us, means we've got ultimately a more resilient underlying business. So look, the three key elements to the Oracle case is, as we saw with SAP, this migration of the ERP, but also the database from on-premise to a SaaS offering in the cloud. It is also an opportunity to grow let's call it Oracle's cloud infrastructure business, which doesn't get a lot of attention, but it's the potential. Well, it is the fourth player, competing against Amazon's AWS, Microsoft's Azure, and Alphabet's Google Cloud Services in cloud infrastructure. You also have more focus on the ability of Oracle and SAP, let's face it, to monetize AI within their software platform. So look, starting with the cloud migration, it's not, the on-premise business shrinks, but the SaaS sales are growing. And it takes a little while for the SaaS part to offset the shrinking on-premise, but you put a higher multiple on the SaaS, let's call it the SaaS profits. And look, half of cloud revenue, half of their sales in their SaaS offering are actually coming from new customers. So that means Oracle is taking share. Secondly, the transition of Oracle database to the cloud has really only just begun, because it was only until recently, Oracle being so dominant in database. Obviously they compete against Microsoft, but the database is just such a sticky offering. Corporates, it's so mission critical. It's so hard to extract, to switch from an Oracle as a provider to a competitor. And Oracle made a decision that they weren't going to offer the cloud version of the database on top of competitor infrastructure. Now, we think they've made a critical decision to reverse that and now offer the Oracle database in the cloud, on Microsoft Azure, on Amazon AWS, in the Google Cloud. And that's fantastic. I mean, that means they can remain one of the best of breed providers of the database as a service, monetize the software, and grow faster. And that's that's high margin. So, you've got this transition similar to ERP from on-prem to the cloud. A cloud-based customer is worth 3 to 5 times more than an on-premise customer over the life of the contract, and that's we think that's a great trend to be exposed to.
And can you spend a little bit more time on Oracle Cloud Infrastructure? You called out that it can be the fourth largest player behind AWS, Azure, and Google Cloud. And you also mentioned it's a part of the business that perhaps the market is not really focusing on. So can you take us through that opportunity?
Yeah, look, we see this business, which, as all these tech companies love their acronyms, OCI growing, at sort of plus 50% per annum for the next few years. Thanks partly because it's somewhat different architecture than the other competitors, lower latency and with higher bandwidth. Bandwidth, refers to how fast data can transfer within the data center, which is critical for AI workloads. So OCI's architecture is arguably got a point of difference. Look, we think that they are winning some marquee clients like Uber, BMW, Porsche. Even Microsoft have announced that they will use OCI for inferencing AI models, powering the Bing conversational search. And on top of that, Oracle has made a strategic decision to adopt a more dispersed footprint, so smaller data centers in multiple regions versus Azure, AWS, and Google Cloud, which have fewer, bigger data centers. So this is allowing them to win in some of those industries that are more sensitive to where data is stored, like healthcare, financial services. And look, they're pricing competitively to win share, but that's fine. But as the Microsoft example shows, they are also there are points of difference. So we don't think it's irrational pricing. We're really, they're pricing to their, let's call it, their points of differentiation against their larger competitors. Now, in the last result, growth, the market was a little bit disappointed that growth in OCI slowed from 70% to 55%, or let's call it over 70% to around 55%. And look, we think that's somewhat temporary. Oracle has done a great job securing NVIDIA chips, GPUs, but it takes time to get the data center up and running. And look, they just can't build the capacity fast enough. So we think this is a timing issue, and we see a lot of potential, for Oracle to win AI workloads, win more than their fair share of AI workloads in the cloud.
So in terms of benefiting from the AI revolution, you've just taken us through how Oracle Cloud or OCI is well positioned from that infrastructure angle. But what is the opportunity for Oracle to monetize AI from the software side?
Yeah, that's a good question, and it's not just Oracle. It's really, the answer really relates to the advantages of being a platform company, in terms of software, not a single feature provider, but a platform provider of software. And we put SAP, Oracle, Microsoft, Salesforce, and there are others, in that category of companies. And we think, number one, it's going to be easier to upsell the benefits, the ability to increase productivity to a business customer. So B2B monetization will be easier than B2C. You also, so as a software company, as a platform software company, you will have, by definition, relatively unique, high quality data, which you can use to train models. And Oracle, clearly, given its position in enterprise research planning, has that. And it has it, in other parts of the business. So that puts them in a strong position, we think, to not only to train models, drive high quality inferences, to upsell as part of, let's call it, additional AI features in their existing software. And we think the market's being a little bit too narrow in it, in terms of the focus on 7 mega cap tech stocks. And in this year will be the year where there'll be a broadening out around let's call it the way the market starts to discount or impute value to a broader range of AI beneficiaries. So look, bringing it together at the bottom line, Oracle is growing earnings high single digit to low double digit, priced on 20 times forward earnings. That's cheap relative to the quality of the business and its growth profile. It's a great pragmatic value exposure to AI. It's priced on a roughly the same market, the same multiple as the market for a higher and more resilient growth profile.
Jacob, we'll wrap it up there. Thanks for your time today. You've given us a great market summary as well as some really interesting insights into Oracle.
Thanks, Alison. Excellent questions as always, and really looking forward to the year ahead.
For further information on Antipodes, head to our website, antipodes.com, and you can also follow us on LinkedIn and Twitter.
The content in this podcast is general information only. It is not advice of any kind and doesn't take into account your personal financial situation, objectives, or needs. You should seek professional advice before making any financial decisions. Stock commentary is illustrative only and not a recommendation to buy, hold, or sell any security.